Howdy, Jacob here. Today we're looking at ticker symbol SNY. We see that it has a 3.7% dividend yield and it is a $130 billion company that I have never heard of. It's crazy. All right, well, I guess it makes sense. Sanofi, I think that's how you pronounce it, was founded in 1973 and is headquartered in Paris, France. It has development, manufacturing, marketing of therapeutic solutions in the US, Europe, and internationally. We see it as a $130.5 billion market cap with $137.3 billion enterprise value. Looks like they have a little bit of net debt, but quick glance, nothing too concerning. 42.8 billion in revenue in 2013, up to 48.1 billion 10 years later. So slow growth. Pretty low return on invested capital. We're seeing mid to high single digit return on invested capital, so nothing too special. They don't get the biggest returns on their reinvestments. We see that short term is about 4.4 billion, long term 15.7 billion. They've really heavily cut back on their long term debt since 2020, so 2 years of $5 and $4 billion payments. And then cash on hand, 13 billion. Okay, so they nearly have as much cash on hand as long-term debt, and then in short-term debt, they have about 4.4 billion. So short-term and long-term, we're looking at about 20 billion with 13 billion in cash and cash equivalents. Pretty solid. They're great cash flow, huge cash cows here. So we have 7 billion roughly in their 12-month, most recent 12 months, and then maybe a 5-year average of 8 billion in free cash flow, 9 billion in free cash flow. Let's say 8 billion in free cash flow roughly. So that dividend payout of 4.4 billion aggregate is maybe 50 to 60%. Not too concerning, honestly. It looks like they use their excess free cash flow between acquisitions. They make a lot of small ones, and then every couple of years it looks like they have larger acquisitions. They use a little bit for reinvestment, a little bit for debt buy down, and then a little bit for common stock. So it looks like 50 to 60% of their free cash flow is going towards dividends, maybe 20% to acquisitions, and then the remaining, whatever that is, 20 to 25% is going between debt, pay down, common stock, and investments. And then obviously if they have a big acquisition, they might go into debt a little bit to fund it, but they can definitely afford the debt that they have. So they have 20 billion total, but again, that's with 13 billion cash and cash equivalents. And with a 5-year average of 8 billion, that's less than 2 years, their 5-year average. And their dividend payout is also very reasonable, just under the 4% that we're looking for, 3.7%. If the stock falls a bit and the dividend payout doesn't change, then the dividend yield will actually go up. And so not too concerning from that perspective. I think I'm ready to start making some assumptions here. I would say that on the revenue side, it looks like they're going to be a low growth business, but probably over a 7-year period positive, I would think. So I'm not going to say too positive, but positive enough to where they'll grow roughly in line with inflation. And then with that, they'll probably still have growth opportunities ahead of them since they were their business started in 1973 and they've been able to grow as much as they have. They'll still hopefully have business 7 years from now that or business growth opportunities for them. And then on the margin side, what's the average here? About 18. So let me do 18, 17 share change. Let's try no share changes. Dividend, I mean, they can afford it, but the last 2 years looks like they've actually gone down a little bit. Maybe I'll assume they increase it 1% every year for the next 7 years. That still gets us to a stock price that needs to fall about 48% before you get a 15% return, given these assumptions. I think this could definitely be a company that I'd look forward to on a dividend yield portfolio because you have a not heavy growth, but slow growth business. So that means that their use of free cash flow going towards dividends can make sense. Obviously, if shares are super cheap, you want them to be buying back shares rather than paying out a dividend. But companies are well known for keeping dividends pretty consistent that are a bit older, called dinosaur companies, which sad that a company in 1973 founded was a dinosaur company, but still they've had a historical dividend of at least 10 years, and it's been pretty substantial every year for that. And I think really we're just looking for some cut in the price so that when we buy it, we get both the 4%, roughly 4% dividend yield, as well as price appreciation, which right now, for the next 7 years, with us saying it needs to fall 48% to get a 15% return, you're likely going to get very little stock appreciation with along with the 4%. So right now, just waiting for that stock to fall to do more research, but definitely something I'd be interested in having in my dividend portfolio. I just want it at a better price. So I hope everyone enjoyed the video and has a great rest of their day.